welcome to Lo que callamos los loan officers, mortgage issues and solutions. That was what we have here for you. And I am with our CEO,
Alessandro Ibáñez,
and mortgage loan officer,
Manny Rodriguez.
and I'm also mortgage loan officer with USA Loans, Zoila Fiorillo. So this is part 2 of our common mortgage problems and solutions. And we're going to jump right in it. We're going to start with question number 5. FHA versus conventional with 6 credit score, guys. I have a client that's asking, I have a 620 credit score. Should I go FHA or conventional?
One of the best ways to determine that is 1, credit score, down payment, how much they have for down payment, and 2, cost, right? The cost of what their monthly payment's going to be, what their closing cost is going to be. Ultimately, FHA allows lower credit scores. Let's say someone has a 620, or they can even go as low as 550 with 10% down payment. But let's say someone has a 620, and in that case, it's better to go FHA because they'll still qualify, not get extremely charged over a higher rate, like conventional. Mortgage insurance is fixed at the same rate, no matter your credit score. And the down payment is still 3.5% down payment. If you have a 620 going conventional, you might have to put more than 3%, 5%, maybe 10% just to get approved. Mortgage insurance then go through the roof. It's going to be double what you're paying for FHA. Yes. And on top of that, the interest rate is going to be very expensive as well. So overall, if you have a lower credit score, FHA is better. If you have a higher credit score, let's say above 680, ideally 700 to go conventional. Because above 700 conventional, you get the best of everything, right? You get competitive interest rates, competitive mortgage insurance. You don't have to pay any mortgage insurance if you put 20% down payment. So there's more benefits in going conventional, and we try to help clients go that route. But of course, we can still do FHA. No problem.
Yeah, but it's interesting because we hear realtors saying, "Oh no, we prefer a conventional contract," and I get it because it is a very tight, regulated type of loan, right? So if you qualify for a conventional loan, you're pretty much well set. But of course, in terms of monthly payments, sometimes the FHA will be a better option because of lower interest rates. Also, you got to keep in mind that even though you go on conventional, when we are talking to customers about interest rates, we'll present you the FHA versus the conventional interest rate. And guess what? You're going to pick FHA because it has a lower interest rate. Not necessarily the monthly payment. The monthly payment is going to be probably a little bit lower on a conventional, but the interest rate is going to be lower on the FHA loan. So it's very interesting how that plays, So we got to show you options, and please ask for those questions when you're reviewing your LE with your loan officer, because of course you will see the difference between FHA and conventional.
Now, one of the things I also want to add that I'm not sure if I missed it, but the debt to income ratio. There's a debt to income ratio differences between an FHA and a conventional.
So if you have more debt, right?
FHA allows you to have more debt.
Yeah, correct.
But if you don't have any debt, then you will potentially qualify for more rather than having no debt and being on a conventional.
Yeah.
Just because it allows you to, have more debt. But if you don't have any debt, it just allows you to have a higher buying power.
Qualification, right? So FHA is for people that have more debt, conventional for people that have less debt.
Yeah. Actually. Now, using part-time for qualification. The question is, I have been working a part-time job for 5 months. Can I use this income to qualify?
Sadly, no. You have to have at least 1 year of part-time income in order to be able to use that. However, there will be exceptions where if you have the history, then you can potentially use that income. But you have to show the history having 2 jobs, right? The full-time for 2 years, and the part-time, or the job number 2, I'm going to call it, for 2 years. There will be exceptions because there is definitely, we have seen the scenarios where you can actually use, less. Let's say you're working for 5 months of this job, we can potentially use it if you show stability and as well as you have the history. But usually, for most people, you have to have at least 1 year on that part-time income in order to be able to use it. Would you?
Yeah, and I could definitely say that in my experience, because I've done a couple of these where it's a gray area, and the gray area is really about the underwriter's going to look at it and say, you have 2 years, or let's say 5 years at this full-time primary job. You have a part-time job, you just started, let's say 14 months ago. It's a gray area because you can technically use 14 months of a part-time income history, but it has to make sense. If you're a teacher at your full-time job and your part-time job is, landscaping or waitress or waiter, whatever it may be, they may not consider that a good part-time stability because you just started it. It's a brand new career. You don't know what kind of you're getting yourself into. But if it's teacher and then part-time teacher at another school or summer school, whatever it may
That
be,
could be considered.
then it might be considered more likely because it's same line of work. You have experience in it already, and they can use less into your history in the part-time job.
But you have to have 1 year still.
You have to at least have 1 year.
So just to clarify, so basically, if you have a part-time where you get paid commission or bonus, not bonuses, commission, or just if it's not a set hours or set income, that could be problematic unless you have 1 year.
Yeah, that's a different thing because that's a variable income, right? So that will be commission, bonus, tip. That you have to have 1 year as well on that.
Only 1 year.
Yeah, you have to have at least 1 year in order to be able to use that. But you have to show continuance that it will continue, in the future. But again, that's variable income, so that's why they need a year to be able to average what you made in that year.
Okay, so just to clarify, if you have a full-time and you've been in that full-time for 2, 3, 4 years, a number of years, and you have a part-time, you need to be at your part-time for a minimum of 1 year to make this work.
Correct. Yes.
Okay, and your full-time doesn't matter if you just started that 5 months ago, even though it's the same line of work.
The full-time, let's call it job number 1, okay? You can be, let's say, 3 months, but you complete that job number 1 with previous history for 2 years, you can definitely use it. That could be a new salary, a new hourly. It could be, as long as it is not variable, right? It has to be something stable. Just keep that in mind.
All right,
It has to be stable.
awesome. Let's go into somebody who wants to buy a house for their daughter. He wrote, I want to buy a property for my daughter. What are my options?
What are your options, man?
One of the best things about, mortgages is that there's a lot of options to help you help others, and in this case, you have a daughter that needs to have somewhere to live, right? And she can't qualify on her own. So you want to buy a property for her. And the best way to do that is one, her being on the loan with you.
Yeah.
And the way that works is that she's the primary occupant and you're there as a second co-borrower, and using your income, you're still getting counted against your debt and all that good stuff, right? Your credit score matters and all that. But she's the primary borrower, you're the co-borrower, the parents are the co-borrower, and you're helping her qualify with the income if she does not have enough to qualify on her own.
We call it that co-borrower,
Non-occupant co-borrower.
Non-occupant co-borrower, yeah.
Does it matter if she has a job or not?
It doesn't matter necessarily. You can technically proceed without having any income from her, but it is better. It looks better if the daughter has a job.
Yeah.
One of the other ways is just purchasing as an investment. I say but it is a little more expensive purchasing it as an investment. The parents can purchase the property as an investment, put 15-20% down payment, and they could have their daughter live there.
Now, I have a question going back to the daughter and the father helping as a non-occupant co-borrower. It can still be a primary residence even though most of the income is coming from the father?
But she meets the requirement. The daughter will meet the requirement of occupying the property, even though there is probably not much income. The parents will come in as non-occupant co-borrowers, like Manny said, and they are pretty much bringing the income to qualify for that. So
okay. And what if the parents have an FHA house and they want to buy another FHA house? Does that still apply?
So the question is, are they going to live there?
Well, the non-occupant father is not going to live there, but he already owns a house. So can he buy another FHA as a non-occupant co-borrower for the daughter?
FHA allows a second purchase as a non-occupant co-borrower.
Yes.
Okay, but that debt's going to count against him.
Yes, correct. Yes,
okay. Either way, even if it's conventional, the debt's going to count. Right? Okay.
Because they're non-occupant. Yeah.
Right. And there is another option where you can actually purchase. He was actually reading the guidelines on this with Fannie, where you are allowed to purchase a house for your parents, for example, and it's still counted as occupants, right?
Correct. The reverse of that is basically, let's say I want to buy a house for my parents that they're on Social Security, right? It's not much they make. So the lender or Fannie Mae, Freddie Mac, they require that to show that my parent isn't capable of qualifying for a mortgage, whether it be low income, whether it be they don't have any income, but they're not capable to qualify on their own. So the way it works is I buy it, even though I already have my mortgage, my own primary home, I can still buy my parents a home as a primary home mortgage with the lower, cheaper terms because I'm buying it for my incapable parent that cannot purchase a home.
Oh, that's amazing. And that's still as a 3% down or 5% down?
Yep. As an lower interest rate, yeah. So
I love that.
The son, can purchase the property for the parents. But the other way around, the parent can also purchase a home for a disabled son or a disabled kid. Okay, that is also allowed, but we have to show disability from the son. So that's
Okay.
also another.
But all these scenarios that debt is being counted against the person
yeah.
who's not having. Okay, I just want to make sure. Okay, so let's go into large deposits.
Maybe that's another question.
Mm-hmm.
What if you don't want that debt to be counted against
Yes.
that person? So let's give that option. So
Okay.
let's say I want to help my son to purchase a property, I don't know, in Florida. So then I will move in with my son, we'll rent out my house, and we'll go live in Florida with my son, right? So that'll be another way that you can so I will be occupying that house with my son, my family, of course, in Florida, and then I will rent out my current home. That's a way that you can actually be able to have lower interest rate, have a lower down payment on this new property.
Okay,
Another option.
I love that. But your son's not going to want you to go to Florida with. All right, so let's go into large deposits. I have someone that asked that. He said, I deposited a large amount into my bank account and my lender's asking for documentation. Why? Why is that? Why do people need documentation?
You have to source everything that is in your bank statement. Just so everybody understands. When we get bank statements, we just don't get it to see that you have money for the funds to close, right? Now, whether it's down payment or closing costs, we actually look at the whole bank statement to see what you're doing with it. For example, we're seeing where you're spending that money. Let's say we have customers that are buying in Virginia, and then we see that in the last 2 months, all your expenses have been in Florida. We will be like, okay, so you say you live in Virginia, why are your expenses in Florida, right? So we ask those type of questions. We will look at deposits, like who's depositing, what type of deposit, is it cash, is it checks? We would ask that. If we see large deposits, like for example, $30,000 into your bank account, and then you have normally a deposit of $2,000, $3,000 every 2 weeks, let's say, we're gonna question that, right?
Yeah.
We will look at the expenses. For example, if you have an expense of a car loan that you're paying on your bank statement, but that is not on your credit report, we're going to also question that, right? So there is a different reason why we look at bank statements. But specifically to that question, why do we need to sort? I mean, you cannot use cash, okay? So because of that, we have to sort where the money is coming from. Now, if it is cash, that's a problem. We cannot use it. But if it is a large deposit with a check, we're going to ask you where that money came from, and we're going to ask you to source it. Who gave you the money? Let's say your father gave you the money, then that would be considered a gift, right? That went into your bank account. But it's a question.
Yeah. What if I sold an asset and got paid in cash, and I had documentation proof of that asset that I sold?
Yeah. So as long as you have the documentation to source it, yeah, you could definitely use it. I remember there was a customer that I remember he withdrew money from one bank account, let's say $10,000, and the same day he went and deposited into another bank account the same $10,000.
Yeah.
And I was able to provide the check. The deposit slip, the withdrawal slip from that bank, the deposit slip, the same bank account, the new one, and then the time frame. This was at 3:05 p.m. and this happened at 3:35 p.m.
So you showed the story.
I was able to source it that way because it made sense.
That's good.
But yeah, we got to be careful with those things. Cash deposits are very tricky to source.
And I encourage everybody who is watching us to check with your loan officer in case you have any additional questions. This is Lo que callamos los loan officers with common mortgage problems and solutions with
Alessandro Ibanez.
Manny Rodriguez.
and Zoila Fiorillo. We'll see you next week. Thanks guys for being here today.
All right.
Bye.